Hi everyone, in today's video we will touch base on what it means to invest. Investing is a crucial tool for long-term financial growth and offers a range of potential benefits. Investing provides opportunities for capital appreciation, income generation, and diversification, all of which contribute to achieving financial goals. However, it's important to note that investing involves risks, and individuals should carefully assess their risk tolerance, conduct thorough research, and seek professional advice to make informed investment decisions. Let's first talk about what it means to invest in stocks. Stocks represent ownership in a company. When you buy stocks, you become a shareholder, which means you have a stake in the company's ownership and future profits. It's like owning a small piece of the company, and as a shareholder, you have certain rights. However, the extent of these rights can vary depending on the type of stocks you own. One of the primary benefits of owning stocks is the potential for financial gain. If the company performs well and its value increases, the price of its stocks also tends to rise. This allows shareholders to sell their stocks at a higher price and make a profit, which is known as capital appreciation. Some companies share their profits directly with their shareholders through dividends, which are periodic payments made to shareholders as a reward for their investment. Stock prices can fluctuate, and there is no guarantee that the value of stocks will always increase. Investors need to carefully research and analyze companies before investing in their stocks. Diversifying the portfolio by investing in different stocks can help mitigate risk. It's also important to have a long-term perspective when investing in stocks, as their value can fluctuate in the short term. Now on to bonds and mutual funds. Bonds are like IOUs issued by companies, governments, or cities. When you buy a bond, you're lending money to the issuer, and they promise to pay you back after a certain time, maturity date, with interest. To invest in bonds, you can either buy individual bonds directly or invest in bond funds managed by professionals. When you buy individual bonds, you can do it through a brokerage account. For bond funds, you can invest through mutual fund companies or exchange-traded funds (ETFs). Remember to check the issuer's reputation and credit rating before investing. Also, consider how long you want to invest, bond's maturity, and keep an eye on the bond's interest rate, yield, to know how much you could earn. Bonds can be a safer investment compared to stocks, but they're not completely risk-free. Diversifying your investments and seeking advice from a financial advisor can help make your bond investments more secure. As for mutual funds, they offer a simple way to invest in a wide range of assets without having to pick individual stocks or bonds. They are suitable for beginners because they spread the risk across different investments, making them a safer option compared to investing in just one or two assets. They are essentially investment pools that gather money from many people to invest in a variety of assets, such as stocks, bonds, or real estate. To get started, you need to decide which type of mutual fund matches your investment goals and risk tolerance. There are various mutual funds available, such as stock funds, bond funds, or balanced funds that include a mix of both. Once you've chosen a fund, you can invest your money by buying shares directly from the mutual fund company or through a financial advisor. Remember to read the fund's prospectus, which provides essential information about the fund's objectives, fees, and past performance. It's essential to understand the expenses associated with mutual funds, such as management fees and operating costs. Regularly monitor your mutual fund investments, and consider diversifying your portfolio by investing in multiple funds to reduce risk. And last but not least, you can also invest in real estate. Let's break this down by categories. First up, residential properties. Residential properties are homes or apartments where people live. When you invest in residential real estate, you buy properties like houses, condos, or apartments with the goal of renting them out to tenants or selling them for a profit. As an investor, you become a landlord, and the rent paid by tenants becomes your source of income. Residential properties are often considered stable investments because people always need a place to live. Next, commercial properties. Commercial properties are buildings used for business purposes. This includes office buildings, retail stores, warehouses, and hotels. Investing in commercial real estate means buying these properties to lease or rent to businesses. Commercial properties can offer higher potential returns than residential properties, but they may also have higher risks, especially if economic conditions impact businesses. And lastly, real estate investment trusts, or REITs for short. REITs are like investment companies that own and manage different types of real estate properties. When you invest in a REIT, you are essentially buying shares in the company. REITs pool money from many investors to purchase and operate real estate assets. They generate income from rent or property sales, and a portion of that income is distributed to shareholders as dividends. REITs provide an easy way to invest in real estate without directly owning properties. They are traded on stock exchanges like regular stocks, making them more accessible to investors. Each form of real estate investment has its own risks and potential rewards, so it's essential to research and consider your investment goals before making a decision. All in all, the most important thing to do when it comes down to maintaining and amplifying your finances is diversification. Diversification spreads risk across different assets, safeguarding your investments during market fluctuations and potentially maximizing returns. This strategic approach fosters long-term stability, mitigates emotional decision-making, and ensures your financial journey remains on track, increasing the likelihood of achieving your financial aspirations. To finish this video, here are a few recommendable books to read before investing. The Intelligent Investor by Benjamin Graham, considered a timeless classic, this book provides valuable insights into value investing and stock market principles. Benjamin Graham's wisdom and principles have influenced generations of investors, including Warren Buffett. A Random Walk Down Wall Street by Burton G. Malkiel, this book explores the concept of efficient markets and argues for a passive investing approach using index funds. It covers stocks, bonds, and mutual funds, making it an excellent resource for beginners. Common Stocks and Uncommon Profits by Philip A. Fisher, written by one of the most influential investors, this book delves into growth investing and the process of selecting exceptional stocks. It provides valuable insights into understanding companies and their potential for long-term growth. The Little Book of Common Sense Investing by John C. Bogle, the founder of Vanguard, John Bogle, explains the advantages of low-cost index investing and how it can outperform most actively managed mutual funds in the long run. How to Make Money in Stocks by William J. O'Neill. This book introduces the ConSlim strategy for stock investing, focusing on technical analysis, growth investing, and market trends. The Boglehead's Guide to Investing by Taylor Larimore, Mel Lindauer, and Michael LeBoeuf, a practical guide inspired by John Bogle's investment philosophy, offering simple, effective advice on asset allocation, index investing, and building a diversified portfolio. The Four Pillars of Investing by William J. Bernstein. This comprehensive book covers the four essential pillars of investing: theory, history, psychology, and business. It provides a deep understanding of investing principles and risk management. The Essays of Warren Buffett, Lessons for Corporate America by Warren Buffett and Lawrence A. Cunningham, a collection of Buffett's letters and essays. This book offers invaluable insights into his investment philosophy and approach to managing Berkshire Hathaway. The Real Estate Game by William J. Purvu. For those interested in real estate investing, this book explores various real estate strategies, including analysis, financing, and negotiation. Real Estate Finance and Investments by William B. Brueggemann and Jeffrey D. Fisher. This comprehensive textbook covers real estate finance and investment principles, including property analysis, mortgage financing, and real estate investment strategies. Reading these investment books can provide you with valuable knowledge and perspectives to help you make informed investment decisions in the world of stocks, bonds, mutual funds, and real estate. That's it for today's video. Don't forget to like and subscribe if you found value in our video. See you next time and happy investing!